Canadians were very careful with their dollars at the end of last year. We have new retail numbers coming in from Statistics Canada today. Let's go through them with Vinayak Seshasayee. He's Executive Vice President, Portfolio Manager at PIMCO. Vinayak, thanks for joining us today. What's your quick take first on the spending in November and then what the last quarter of the year will look like?
Well, the spending in November was quite strong, but with these retail sales numbers, I think one thing we always like to caution people is that month to month, they tend to be very noisy. If you recall, November, the Jays were playing, and one of the big driver of upside surprise in retail sales was in food and beverages, so there could be a correlation there. We're also seeing a bit of give back in December. We really like to look at retail sales more on a trend basis, really see how it's been trending over the past year or so. And that tells us that it's really been much more flat to sideways. So on a real volume basis, we actually haven't seen any growth in retail sales over the past year or so. That is consistent with the signals we're getting about the economy from other sources like, GDP, the business surveys, et cetera, that it has generally been a tough year for the economy. The consumer has overall been feeling the pinch in their pockets. And I think that kind of lukewarm economic state continues.
Okay, so is it still then tariffs that are concerning people, or is it world conflict and the possibilities there, a combination of both?
For Canada, domestically, we think there's two main issues that are concerning people right now. One certainly is the uncertainty related to tariffs, which is going to continue to be a headwind to the economy this year. The second is housing. Housing, as you know, has been facing a rather tough path, particularly in Ontario and BC, which are the two biggest markets in the country. And house prices in Toronto, the GTA in particular, are now down almost 25%, depending on where you look. So I think those are the two main concerns. And I think those are probably the two biggest headwinds to growth over the next several months.
Okay, let's talk about CUSMA. I'm wondering how concerns about the trade deal not being renewed are hanging around. We had recent comments this week by Howard Lutnick talking about Canada's deal with China and how that could affect discussions. Do you think that is still something that's weighing on people?
I think it's something that genuinely should be a concern. It is up for review this year, and we actually see many possible paths that these negotiations can take. Not only Howard Lutnick, but also the U.S. Trade Representative Jamieson Greer has alluded to the possibility of not renewing CUSMA in its current state as a tri-party agreement, but maybe moving to bilateral agreements, one with the U.S. and China and one with the U.S. and Mexico. And the additional thing is that the trade relationship between the U.S. and Canada is probably the most complex, maybe with the exception of Mexico. So it was a lot easier for the U.S. administration to negotiate some of the other trade deals with countries on different continents. With Canada, just because the relationships are so deep and intricate, it's likely to be a long and protracted negotiation taking several months. There are likely to be a lot of headlines during those months that may drive not only markets, but also sentiment and businesses' desire to invest and create jobs. So we do think that it's likely to be a concern that's going to weigh upon people. Maybe to some extent, it's already factored into how businesses have been operating, in the sense that, the slowdown in the economy that we were going to see because of the trade uncertainty was already felt in 2025. And so maybe the shock in 2026 won't be that big. But there still is quite a lot of uncertainty around this. And so it is one of the major issues that is at stake this year.
I'm wondering if you think the Bank of Canada cuts that did happen, the rate cuts last year, provided relief for borrowers.
It definitely provided relief for the housing market. And we do think that if those rate cuts had not come, you would have likely seen the overall state of the housing market potentially in worse shape. So, we think that the Bank of Canada was absolutely right to embark on a fairly aggressive easing cycle, bring the overnight rate to 2.25, which is actually a little bit below their estimate of neutral. And they've signaled that at these levels, they do see themselves as having provided the right platform to allow the housing market and the economy to recover. So we are under no doubt that it's helped the economy.
Okay, so give me an understanding of what you expect for this year, because the Bank of Canada has signaled that it is probably where it's at and where it's going to be, at least for the near future. Do you expect a rate cut by the end of the year?
We certainly don't see any action for the first half of the year with rates where they are. And in fact, because our baseline is that the US will eventually reach a deal with Canada on trade, our baseline continues to be that the BoC will be on hold through this year. We don't see further rate cuts, and that's partly because the current level of overnight rates in Canada at 2.25 is actually a lot lower than many other developed countries. And if some of these headwinds weren't there, it would actually be allowing the economy to recover quite well. And we also think some of the further kind of challenges that the housing markets face are more related to frictions in clearing risk and transfer of risk as opposed to rates themselves. So there may be other solutions required. So our baseline is that the Bank of Canada remains on hold. We're definitely more confident about that for the first half of the year. And for the second half of the year, I think there's really quite a range of scenarios because in addition to these trade uncertainties, what we've also seen over Q4 is that we've seen some healing of the labor market. You know, we saw the unemployment rate fall from 7.1% down to 6.8%. I can easily see a scenario where if the unemployment rate were to fall another half a point, there may really be no need for the Bank of Canada to consider any further cuts. So I think the year is a long period of time. We certainly don't see them moving in the first half. What they do in the second half is going to be a function of how the labor market recovers and how these trade talks go.
All right, Vinayak Seshasayee, Executive Vice President, Portfolio Manager, PIMCO. Thank you, sir.